Most beginners lose money not because of they don't know how to trade, but because they trade in the wrong direction. Today, in just few minutes, I'm going to break down the simplest and the most powerful concept in trading, trend following. If you master this, your accuracy and confidence will immediately improve. Welcome back to the channel. I'm Divakar and I'm simplified trading for complete beginners. This video is part of our approximate 30-day beginner to confident trader challenge, which I'm doing it for the last couple of sessions. So if you haven't watched the previous lessons, add them to your watch list. Why trend following works? Trend following works because markets move in waves, not in random chaos. Institutions move slowly, building positions over time, and that creates visible direction. Well, the three types of market trends are there. They are, one is uptrend, higher highs and higher lows, and the second one is downtrend with lower highs and lower lows, and sideways, or you can say consolidation phase where no clear direction would be there. Most beginners fail because they try to buy in the downtrend or short sell in the uptrend. So, how to identify a trend in a simple method? Here's the easiest rule. Use the 50-day moving average. If the price is above 50-day moving average, it's called uptrend. And if the price is below 50 moving day average, it's called downtrend. Just follow this. And if the price is moving around the line, then it's sideways. You should avoid trading. This method alone filters 50 to 70% of the bad trades. Well, there are entry rules for trend following. Once trend is identified, we don't just jump in, we wait for a pullback. So there'll be an entry rule like this. For uptrend, you have to buy near the previous support. And for downtrend, you should short near the previous resistance. Also, you should look at fixing a stop loss and the exit rule after this. Once the trend following is not just about entries, exits are even more important. Well, as I said, the rules are, for stop loss, once the price goes below the last swing low in an uptrend, and that is where you should keep the stop loss, or you should stop loss above last swing high in a downtrend. Let me repeat once again. Stop loss is when below last swing low in an uptrend, okay? And in a downtrend, it is the above the last swing high. Pretty simple right now. So you should exit when the price closes beyond the 50-day moving average in the opposite direction. Well, let me just come to the common beginner mistakes now. So, you keep buying because the price looks cheap. Never buy a stock just because it's a good company and the price looks cheap, because there could be some other reason, and the price may not move for a couple of years. So you will get stuck. Or just predicting the tops and bottoms. You see a good uptrend move or a downtrend move, you yourself decide, okay, it has done the top or the bottom, so let me buy here. Don't do that. And when the market is trading sideways, that is the time you should never buy, and don't do over trading also. These are the four common beginner mistakes you should avoid. And well, let me show you some real example which is back tested here. Well, I've taken the Reliance example here. You can see, suppose once you take this stock into your watch list, you see the trend going up and wait for the pullback. And this is the first pullback you can see here. And then, it's taken the above of the 50-day moving average. So I have used the 50-day moving average here. And once it starts again the upward trend, and this is where you enter. And now this blue mark symbolizes the previous swing, and this is the stop loss you should keep, and this is the entry level. So from here, again, the trend moves, and actually, you can see the closing happening before the trend line, which is the 50-day moving average, and that is where you can exit. And because you are sure of the uptrend continuing, you can perhaps re-enter here, which will take you all the way here until the next stop loss is hit here. And this is how a trend can be followed with a very disciplined manner. And you can see a long, you know, journey of the uptrend here. You can catch up all the way this and also this, and continue the journey whenever the market is going up. So this is a typical example. So first thing is, say, following the trend with the 50-day moving average, then entry after the pullback, and keeping a stop loss with the previous swing low, and exit once the again when the trend or the price closes below the 50-day moving average. So this is the pattern, and if you keep this, the pricing what you enter versus the return on profit would be one of the best. So the summary and the key takeaway, which I can say, is trend following is simple, mechanical, and repeatable. Do not predict, just follow the market, and that's how it works. Well, are you going to start with the trend from today? If you found this valuable, hit the subscribe button and share with your friend. And if you want a full beginner-friendly roadmap, join Smart Trade Circle, and link is in the description.